Hello friends, starting with second video in the series, and last time we completed forwards. Today we have to continue with futures. Could be slightly longer session, but it's interestingly before we start with, a few days back I had a call from one of the students asking the relevance of these videos uh, as far as the curriculums are concerned. Like, are these for CFP or CWM? I said it is for both. As of now, for the basic part, it's going to be common. Like CFP, CWM doesn't have any difference in terms of the derivatives. Derivatives concept is universal. But yes, when it comes to the pricing part and strategies part, so those who are CFP students, they would not be looking at those videos, and they will be only for CWM students. Fine. Now let's move on. I've got a couple of my students who are attending this session silently. Fine. We start with the concept of futures. So we continue with forwards only, in fact. So like forward contract, a future contract is an agreement between two parties in which buyer agree to buy an underlying asset from the seller at a future date at a price that is agreed upon today. So far, this is same as what we had in forward. कोई difference नहीं है. However, unlike forward contract, the futures contract is not a private transaction, but gets traded on the recognized stock exchange. So do understand, forwards have been private contracts. It can be between me and you, but that's not the case with futures because they are on the stock exchange. Now you'll definitely ask me, then which market is bigger? Forward is bigger, future is bigger, which one is better? We'll take care of all the questions as we progress. Now, forwards are customized contracts because that is between me and you, private contracts. However, futures are on the stock exchange, then they have to be standardized by the stock exchange properly. So let's look at it. How does it go? In forward, buyer knows the seller. They enter into a contract. They know each other. At the end of it, they like deliver the goods and terminate the contract. But in case of futures, because they are on the stock exchange, it maintains anonymity. That means buyer doesn't know who the seller is, and same is the situation with seller. There is a clearing corporation, or simply say stock exchange in between, who knows both the party individually. Now something very interesting which should come to the concept says that when the seller wants to deal, he has to pay some margin or earnest money or deposit, whatever you say, to the stock exchange. Then and only then stock exchange will allow seller to get into the contract. And same is the situation with buy. So when there is a stock exchange, you can see the flow. The seller sells futures contract to the stock exchange. So stock exchange is actually acting as a counterparty, and buyer is actually buying from the stock exchange. And buyer makes payment to the stock exchange, and similarly, you can see that seller has to recover money from the stock exchange. So this is the typical chart which has been suggested, right? So it maintains anonymity, but in common, both parties know stock exchange. And stock exchange acting as a counterparty, taking the deposit money, earnest money. So last time, definitely we raised the concern about the default risk, either party not fulfilling the promise. That is not going to be here. And there is one more thing to come up in this case. So standardized contracts in terms of underlying commodity or asset. Now, see friends, if there is a forward, there can be any commodity, any asset in which we can enter into a contract. That's possible. But when it is on the stock exchange cannot have open-ended contracts. They have to have defined commodity, defined assets. So you can go to MCX, you can go to NCDEX, you can go to NAC, BAC. You'll find out the defined contracts. So in terms of the asset, that is like you go to commodity stock exchange, you will find out the list of commodities only on which you can enter into the contract. And similarly, you go to BSE or NAC, you will find out what all different types of derivatives available. You'll find out futures on limited number of stocks. We'll also find out futures on limited number of currencies. We'll also find out interest rate futures. So list is always defined. It's not open-ended. Then quantity. So when I'm talking about quantity, stock exchange also defines the quantity. So when say there was a farmer merchant example, we continue with that. So merchant said that whatever be the produce, I'll buy. So there wasn't any fixed agreement for the quantity. Or say there was also a contract for quantity, any up and down can also be mutually understood. But when you are dealing with stock exchange, and stock exchange says that the quantity has to be minimum 1 ton and multiple thereof, then farmer is bound to deliver in the exact quantity. Like if he's having short, then probably he has to buy and has to deliver to the stock exchange. One more thing: maturity, delivery date, and delivery terms. So when the contract should come to an end, then how the settlement would happen, in the sense like who will bear the cost of transportation, everything has to be defined by the stock exchange. Now, of course, there would be a question which will come to you. If it is delivering shares or gold, that is possible to be given on a particular date. But when I talk about agricultural produce, how can I set a defined maturity date? So that's a concern. So we'll find out that answer once we start with what is hedging, what is speculation. I'll guide you with that. Next is exchange traded. Now this brings in one more interesting beauty. This says that forwards are very difficult to terminate, or probably if you want to terminate it in the contract itself, the exit clause is mentioned. So whatever has been the financial like repercussions of that clause, then the party who wants to make an exit has to be ready to bear. But that's not the case with futures. Like we buy shares from the spot market or cash market, similarly, you can buy the futures. Definitely, it's a different market. Cash market is one segment, derivative market is another segment. You have to pay the margin and all. But yes, you can get into the futures. And as and when they are favorable to you, you can sell it and make an exit. So it gives you good amount of liquidity. So exchange traded is an interesting part. So mostly you will find out not the parties with vested interest. Like, so I'm a farmer, I'm having rice. I would better be entering into forward than getting into the futures. In futures, you'll find out speculative interest. In forwards, you'll find out more number of hedgers. Now, guaranteed by the clearing house. So, as we saw in the chart or the diagram, that it is there is always a stock exchange which is acting as an intermediary, and hence it ensures that there is no counterparty risk. In forward, there was used to be a trouble that there is no money which is changing hand during the contract, neither at the start of it. But in futures, it is to be settled on daily basis. We call it mark to market. So say, for example, the agreed price for a commodity was 100 rupees. Say, for example, 100 rupees per kg. This was to start with. Now, it happened to be 101, and say this is buyer and seller. So fixed price was 100. Now it is per kg 1 rupee plus to the buyer. His account is credited. Seller has to bear the loss. So his margin account is debited by 1. Similarly, it happens to be 102. Then further on the next day, plus 1, minus 1. It happens to be 100 once again, then minus 2 and plus 2. So this also gives you an idea that buyer in the contract makes money when the prices go up. And of course, we understand it that he entered into the contract at a fixed price of 100. So whatever be the price, he is obliged to pay 100. He has to execute the contract if he continues. And with increase in price, definitely he'll make money. So when buyer has a profit, then who is going to pay that profit? Seller. So seller's loss is buyer's profit. We can understand that way. So seller has to sell something worth 102 at just 100. So you can understand that's the loss to the seller. And this profit and loss are settled on daily basis. They are settled in the margin account. If margin account goes below a particular limit or a level, then there is a margin call. And once again, your margin account is restored. So that is also one more interesting term that we can come across, that is called margin call. Right. So we have got initial margin, we have got maintenance margin. Anything below maintenance margin, that means you have to reinstate the account. by paying the money. So that's interesting mechanism. So margin account is needed, and that is ensured or acts as a collateral. And somebody doesn't maintain the margin account well. So that means the account balance has gone below maintenance margin and he's not paying it, then his position will be terminated. And whatever has been the balance in the account will be paid. Of course, there will be penalty and also that is absolutely beyond our discussion now. But this is standardized. So, like if you want to hedge your import export, you will definitely be better going to a bank getting into a forward transaction. Farmer merchant will get into forward transaction. But those who want to deal with commodities or shares, want to speculate, probably for them, this is going to be the best one. So we are not saying that which one is better, which one is not, but we are trying to understand both the concepts. Users are different in a way. So futures, the difference between the forwards and futures. So first we talk about futures. So they are on the stock exchange. So organized instrument, standardized terms, right? They are liquid because they are traded on the stock exchange. It requires margin payment and it follows daily settlement. We have seen this. Now forward on the other side are OTC, means they are the private contracts. They are customized contracts. This is the beauty with forwards because they are customized. Less liquid, no margin payment because there are only two parties, no intermediary, so they cannot pay margin to each other, of course. And settlement happens at the end of the period. So this is how you can compare forwards and futures. Futures are significant improvement over the forward contracts as they eliminate counterparty risk and offer more liquidity. Definitely. But as I said, the users are different. Now, understand three different parts. So in our case, once again, we go back to that farmer merchant example. So farmer was hedger because he had a risk. He had a risk and wants to transfer the risk. He is hedger, right? So if I'm having portfolio of shares and I enter into derivatives to protect myself from the probable losses, then I'm a hedger. So if I'm having a pre-existing risk and I transfer that risk using derivatives, then I'm hedger. So hedging is a mechanism to reduce the price risk. And derivatives have been created for this purpose only. So what I understand is if you are using a product for a purpose which is other than for which it was created, then definitely it can bring in trouble for us. So hedging. So if farmer is a hedger, then who was merchant in that arrangement? So I'll say merchant didn't have any pre-existing risk, but he assumed that risk with an anticipation of making money. Then he's considered to be a speculator. Now you will also understand the importance of speculator in the entire mechanism. Only hedgers cannot make the market. You will definitely have less number of participants if there are only hedgers which are coming to the market. So hedgers also need a speculator for hedging activity. And another is arbitrageurs. So arbitrageurs are those people, typically we can say they buy from one market and sell in another market to earn from price discrepancies. But when it comes to derivatives, so we have got cash market, we have got derivatives market. Now prices are different, but there is also a pre-established relationship that we have to learn eventually. So if prices are not following that equation, or there is a discrepancy in the price, then arbitrageurs will make sure that both the markets run properly and they try to make risk-free profit. So hedgers, speculators, and arbitrageurs will find out all the players in the market. Now look at this one. Futures means obligation. Forwards also obligation. Obligation means what? So say for example, I've entered into a contract to buy something. Here I have taken Nifty at 2200. That means I have to buy. If I don't terminate the contract, so future, that means you can sell it on the stock exchange and you can move out. So this, first of all, it is buy, forward, or future. So 2220 is my pre-agreed price. Buyer makes money when prices go up. Buyer makes money when prices go up, and he loses money when prices fall. He is obliged. So whatever his position, he has to execute contract. So that is called obligation. So buyer makes money when prices go up and loses when prices fall down, and both can be substantial. Both can be substantial. Now, counterparty, that is the seller. So you can understand when buyer loses, seller makes money. So definitely he has fixed the selling price at 2220. If price falls down, then he will still be able to sell at 2220. So that's the profit to him. This is the profit to him. So seller tends to make money with fall in price. And when prices go up, he will end up selling something worth 2280 at 2220. So that is how we can understand the situation to be loss situation. So seller makes money when prices fall down. Seller loses when prices increase. Buyer's profit, seller's loss, and vice versa. So this is the payoff. Now, next thing we have to start with, probably in next 2-3 days, I would start with options. So watch these videos timely. Also refer to first videos. Follow all these videos and don't believe that these videos are going to be there on YouTube forever. So I've done it in past, that I kept on uploading these sessions and I deleted eventually. So this is in a way a study session, free study session going on derivatives. So keep learning with me. They are not going to be permanent. I may unlist these videos eventually once the series is over. So keep watching, and if you have any doubt, post it. We would also be solving many numericals in this series. So keep watching and post the doubt, and also your suggestions are most welcome. See you in the next video in mostly 2-3 days. See you. Bye.